So today we're going to talk about a couple of really important topics that our office hears a lot about. We're going to talk about why do stock markets go down, or why does the market have so much volatility, and what do you do with your behavior and understanding a lot about consumer behavior. So this is something that really impacts everybody that comes into our office or contacts us on radio. And so let's begin with understanding why markets go down. Now that may seem pretty basic, but a lot of people have the expectation that the market is always supposed to go up. The reality is, all the way back through the 100 plus years that the market has been in existence, there has been contractions and expansions, there's economic cycles, and these are things repeat themselves over and over again. You know, I've been doing this for around 24 years, and over my career, I've seen huge drops in the market, everything from the tech stock bust to that we had in the early 2000s to the Lehman collapse in 2008. And then we had the European debt crisis. We've seen COVID and inflation. And so different market cycles are going to take place. And the market is not designed to always go up. You certainly want to be participating in the market when it goes up. But when the market goes down, you need a couple things. You want to have a good plan. You definitely do not want to act out of emotions or fear in market downturns. And you want to look for opportunities, because drawdowns in the market happen for a wide range of reasons. But they present a long-term investor with some wonderful opportunities if you approach that the right way. So let's talk about why markets drop. Well, markets drop for a lot of different reasons. And one of the things I would add to this is even in a healthy bull market, there tends to be times throughout the year where the market will correct 5%, 10%, sometimes 20% on its way to a positive return for the year. So market volatility exists in a bull market, even like it does in a bear market. What can cause a market to go down? Well, probably the most recent downturn in market history was 2022. We had, historically high inflation. The Fed went on or embarked on an 11-time interest rate increase. They increased rates 11 times over 22 months. Capital became more expensive and the economy began to slow down. Now, the good news is we've not had a recession. A lot of economists were calling for a recession. But what really caused the market to go down was a lot of fear in that we were headed into a recession. And so, again, that's a normal part of what happens in market cycles. If we go back to COVID, back to 2020, when COVID took place, really from about the middle to end of February, all the way down through April, the market almost went in a straight down line. And the fear there was that we had this 100-year pandemic, that the economy had come to a screeching halt. And remember, there was quarantine and there was very few places that were open, and there was essential needs businesses that were able to maintain, and we got more into Zoom instead of face-to-face. So there was a lot of fear. And in the initial stages of that fear, there's a tremendous amount of selling pressure in the market. And so the market went down. The market is like an auction. You have a buyer and a seller. And if you have more sellers in the market, then the market is going to tend to go down versus if there are more buyers. But what happens with investor behavior, and I think this is really important to understand, is people want to believe that they buy low and sell high. Most people actually go the opposite direction of that. They actually buy high when they're feeling comfort, and they sell low when they're feeling pain, because it's really painful to look at your accounts going down in value. It's really painful to get statements that are going down in value. And so unfortunately for a lot of people, they were getting out of the market at a time where the market was probably bottoming out. I can remember personally speaking to a gentleman who was in his mid-40s in April during the COVID-19 pandemic, and he had sold everything he had, even though he didn't need any of the money he had. It was for retirement for 20 plus years down the road. He had sold everything and put it into cash. My encouragement to him was that he go back into the market and buy back the positions. We did some analysis on his portfolio, because I said, again, you don't need this for 20 years. And, volatility is part of that. Now, I don't ultimately know what he did, But I do know the market bottomed in April and then pretty much went straight up. The government put stimulus into the market. So if he went back and he bought back the things he had sold, he probably ended the year pretty happy. But if in fact he let fear continue to permeate his life and be the overwhelming response to his investments, and he stayed in cash from April through the end of the year, it probably wasn't a very good Christmas for him, because he would have missed out on the market essentially fully recovering by the end of the year. And so it never benefits people to act out of fear or emotions in market downturns for a wide range of reasons are going to take place. And typically, when the market starts to go down, what you're going to see is a lot of panic selling, and it's not something that you want to be a part of. Certainly, you should be able to pick up the phone and call your financial professional and have them walk you through how they're handling your money, making sure that they're on top of what's happening. We're certainly not implying that you should be naive. What we're implying is that you should not act out of emotions. When you act out of fear, when you act out of emotions, it does not benefit you and your family in the long term. I always mention a leading research firm called Delbar. And Delbar, for decades, and I mean decades, has studied investor behavior. And what they have proven decade after decade is that investors don't buy low and sell high in large numbers. They essentially buy high when they're feeling comfort and sell low when they're feeling pain. And then it just becomes a self-fulfilling prophecy where people get discouraged and they think they can't have a good investment experience. So a couple of things. Don't allow emotions to drive your investment decisions. Don't panic sell in market downturns. They're going to happen. And don't follow the herd. One of the other things that I think is really important and has proven itself out, whether you're buying or selling in the market, is many people, instead of having a good plan and really working through what they want to accomplish over a year's time period, and 3 years and 5 years and 10 years and 20 years, they talk to people who really aren't wise to the market, really do not have a background in helping them plan, and they kind of go with whatever everyone else is doing. You know, when you follow the herd, it does not tend to work out for you. What you want to do instead of following the herd is you want to have an individualized plan for yourself and your family. You want to know, for example, what kind of investor are you? Are you conservative? Are you moderate? Are you more aggressive? If you're younger, you can probably afford to be more aggressive. And in most cases, you probably should be. And there are exceptions to all that, but you should know who you are as an investor. And then you should demand from the financial advisor or professional that you're entrusting your money to that they're building a profile and fully explaining that to you that matches who you are as an investor. And when these times of turmoil come, we have to sort of back away and remember where we got started. If we set up our investor profile, we set up our plan, and we understood who we were from the start, we can kind of reanalyze that and feel pretty good about where we're headed. And one thing I would say about recessions, there's been a lot of talk about, is the U.S. economy going to go into recession, or we're going to have a soft landing or a hard landing? Nobody really knows that. But at some point, all of those things are probably going to happen. It's not a matter of whether it will happen. It's a matter of how do you want to handle that? How do you want to react to that? And do you look for opportunities, or do you follow the herd? Do you panic sell? Do you do things that are relatively short term that impact you for decades? So what I mean by that is the average recession. Let's assume the U.S. economy goes into a recession. Not saying it's going to do that. Again, I don't think anybody knows whether it will or not. But the average recession lasts in duration probably 12 to 18 months. It's relatively short term. But decisions that you make during those periods of time can literally affect you for the rest of your life. That's how important decisions like these are, that you have a solid plan, that you're not acting out of emotions. But I would also say to you that one of the most important things I really feel about being in the market, and I believe people should be in the market. Over time, the market has proven, yes, it has hiccups and corrections and recessions and crisis that happens. But over time, the market has proven it is a good inflation hedge. Your money will grow if you have a good investment plan, and it helps you achieve your investment objectives as you plan for retirement and certainly as you get into retirement. It is really important that you have a good plan. It is vital that you have a good diversified plan. It's really important that you work with an advisor that doesn't run and hide when things do get chaotic. You can actually get them on the phone or come in and see them, and you can communicate how you feel, and they can communicate to you your plan and what they're doing during those situations. Because the truth is, it's really easy to look good as a financial professional when the market's going up and the economy is doing well. I truly believe one of the biggest tests of a financial professional is what they're doing or not doing in the crises that we see and in the downturns, and how are they guiding you and your family through seasons like that. But over time, the market makes money. Fidelity had some research that came out recently that studied the stock market all the way back to 1986 through December of 2022. And what this study said was that if you invested $10,000 back in 1986 at the end of 2022, and the market's been up from here, your money was worth, if you invested nothing else, over $177,000. But if you just missed 15 of the best days, now think about that. 36 years of history. During 36 years, you just missed 15 days. You're in the market for all the upside and downside and all the volatility, but you're not in the market for just 15 days. That's less than a half a day a year. Your money, $10,000, would grow to under $65,000. So you would have essentially 3 times as much money by staying invested and working with a professional that can really help guide you through seasons like these. So a couple of takeaways. Understand that market downturns are going to come. Chaos happens in the world, but the market recovers and over time it grows. Number 2, don't act out of emotions. Don't act out of fear. Make sure that you're sitting down with your financial professional, whether the market is going up or down, and that you're re-examining your plan. You're being reminded of why you're doing what you're doing, and that you're constantly adjusting that in some ways if you need to, but you're sticking to the plan. You can go into finance without a plan, but not having a plan really is a plan. It's just planning not the plan, and that's not very good for you and your family. Well, if anything we've said today is something that you'd like to get more information about, we would love to talk to you and your family. Give us a call. Our number is 615-488-3039 if you're interested in even just talking about some of these things and how we might be able to help answer some questions for you and your family and guide you through not just the good times, but the bad times that we're inevitably going to see in the market and in the economy. Thanks for listening, and we will talk to you soon. Click the subscribe button below.